It is April 15th, 2026. While trade halts in Iran and rising tensions in the Middle East suggest a flight to safety, Bitcoin is holding a price of $74,230. At the same time, the Nasdaq is currently halfway through a 10-day winning streak. Both tech equities and digital assets are climbing simultaneously. For most of the last decade, these two markets were entirely separate. You had the legacy institutions on one side and a decentralized, often hostile ecosystem on the other. This mass adoption didn't arrive as a total replacement of the US dollar. Instead, it manifested as a quiet, aggressive integration of the two systems. The opposing forces of global finance are now running on the exact same digital plumbing. To see how that works, we have to look at the market from the top down and the bottom up. We start with Goldman Sachs. Their recent regulatory filing shows how legacy firms are shifting from simply watching the market to manufacturing profit within it. They've proposed a Bitcoin Premium Income ETF. Usually, a Bitcoin ETF is a simple vehicle. The fund buys the coin and tracks the price movements for its investors. Goldman is using a covered call strategy. It functions like real estate. Rather than waiting for a house to increase in value, you charge a fee for the right to buy it later. You keep that fee as rent. They apply this mechanic to Bitcoin-linked instruments to generate income for investors without buying the underlying asset. Wall Street has moved into a more complex phase of extraction, engineering systems to collect rent from the crypto market's volatility. While institutions engineer for yield, technology platforms are giving retail users direct access to live financial data. X has launched cash tags for US and Canadian users, pinning real-time charts directly to their social feeds. This allows the average user to monitor the market with the speed of a Bloomberg terminal. Beyond tracking the data, Tether is now providing a way for its 570 million users to hold the assets themselves through a self-custodial wallet. In the past, self-custody required securing a 24-word seed phrase, a single string of words that, if lost, meant your capital was gone forever. Tether is replacing that friction with a human-readable interface, allowing massive populations to bypass centralized exchanges while maintaining control over their USDT and Bitcoin. This demographic is growing. Pakistan recently lifted a 7-year ban on crypto banking, legally opening digital asset access to 200 million people. While the banks build for extraction, the tech sector is building tools that give the individual unmediated control of their wealth. These two worlds meet at the infrastructure layer, the invisible middle where every trade must be processed. Mitlify just raised $45 million to build AI-driven documentation. This is a library for the AI agents that now navigate the web, giving them the instructions they need to execute software code on the blockchain. In the Ethereum ecosystem, Ether.fi recently moved $3 billion worth of staked ETH to provide validator liquidity. This liquidity acts like the cash on hand at a toll booth, ensuring that high-speed global transactions don't bottleneck as they move across the network. Whether it's an AI agent or a Goldman Sachs trader, this rebuilt Ethereum plumbing provides the capacity to keep the 2026 economy running. The capital moving through these ETFs and retail wallets shows that the separate lanes of traditional and digital finance are now intersecting at high speeds. You have $500 million flowing into institutional ETFs in a single day, contrasted by a retail market that remains as chaotic as ever. Today, someone paid 54 ETH, over $125,000, for a digital wrapped Ether rock. Meanwhile, the Chill Guy meme coin lost 15% of its value in hours, illustrating the extreme volatility that still exists for speculators. The infrastructure is operational, leaving you with a choice. Do you let a bank manage your yield, or do